Greetings, fellow investors. I'm Matthew Cochran, a lead advisor at Seven Investing, where it is our mission to empower you to invest in your future. We do that by providing monthly stock recommendations to our premium members and educational content that is freely available to everyone. Listeners, today I am very excited to introduce Andrew Freedman. He is a CFA charter holder and the managing director and communications sector head at Hedgeye. If you're interested at all in some of the market's most exciting industries like entertainment, telecommunications, he is a must follow on FinTwit, where he can be found at Hedgeye.com. That's at HEDGEYECOMM. Today, he's going to walk us through these industries and how they're changing through cord cutting and streaming, and who some of the winners and losers in this space might be. Andrew, welcome to the show.
Thanks for having me. Excited to be here.
Awesome. Andrew, why don't you start off just by telling us how you first got into investing and what led to your current position at Hedgeye and what you do there?
Yeah, it's a fun story. So I'm kind of a underdog, maybe you could say. At Hedgeye, they call me a mutt because a lot of the folks here have Yale backgrounds and Ivy League backgrounds, and I don't. So I've always kind of going back to, even when I was in high school, I've always had a passion for investing, very interested in it. It's kind of had an interesting path back then that led me to going to school in the Midwest. So I went to Marquette University, went through their finance program there, got into one of those investing management groups that was very focused around the CFA. And we would pitch stocks. We would manage. We managed about, I think, $250,000 of the university's endowment. We would have alumni come in and grill us on the stock ideas, and it was something that I've always really enjoyed doing. But coming out of a school from the Midwest, even though Marquette was a great program, and my background being on the East Coast, there was always limitations. It's a very competitive industry. It's hard to get on the buy side and the sell side. I didn't want to go to banking. That just wasn't what I wanted to do. So I was fortunate enough to get a job out of school for a couple of years at an institutional consulting firm, which gave me a really great macro perspective, doing investment due diligence on money managers, speaking with PMs, doing asset allocation. And I think that gave me with a great perspective in terms of what doesn't work and what does work for a lot of investing strategies by speaking with some of the smartest people that manage billions of dollars. And then also just understanding how asset allocation works and the types of decision-making that occurs from a pension fund to an endowment foundation. During that time, I just always was kind of a stock junkie. And so I did a lot of my own investment due diligence and my own investing, both for our high net worth clients back then, but also I would post my stuff on like Seeking Alpha to try to get feedback. And then one day a coffee maker got delivered to our office that had the label Hedgeye on it. And it came to our office and we're like, Hedgeye, what's this? Hedgeye. And so it turned out that back in 2013, Hedgeye was just growing rapidly and moving into the offices that we are now that you see behind me in Stanford. And did some research on the company. It had lots of the investment philosophy and what they were doing really resonated with what my passion was. And so I kind of bullied my way in there, went through the interview process, started off in healthcare, cut my teeth doing a lot of stuff in managed care, hospitals, but really focusing a lot of my time on healthcare IT. So I've done a ton of work historically on like the Teladocs of the world, Cerner, Athenahealth when it was public, getting involved in that controversy. And then a couple of years ago, I had this opportunity to take over the internet media and telecom sector and take a lot of what I learned and built from my days in healthcare IT and apply it to this space. So it's been a wild ride. It's been a lot of fun, but I wouldn't want to be anywhere else. It's a great culture, great teammates that we have, and what we're building is just it's a lot of fun. It's very exciting. So it's pretty much my background.
Oh, that's great. I can't wait to dive into our conversation today. This is just a fun industry to talk about because so many of us use and love these companies. So let's just start off with, the media and entertainment world is just rapidly changing. Now, there are still songs and TV shows and movies like always. I don't mean to suggest that the content itself is changing, but how people are consuming this content is just rapidly changing. As streaming apps gain in popularity, the cord cutting phenomena only seems to gain momentum. At this rate, pretty soon, it almost seems like I'm going to need 9 to 10 apps just to watch every show I want to. Can this keep up? Is the cable bundle doomed? Where's this space headed?
Yeah, I mean, it's like you kind of described it perfectly, right? We're undergoing a massive change in the landscape for content distribution from linear legacy models, primarily distributed through cable, where the cable companies pay the media companies an affiliate fee or recurring subscription fee per month based on the number of subscribers that they have, and which is very, very high margin business for the studios and the entertainment companies. And now we're going over the top. It's going all the internet, and that's been pioneered by the Netflix model, which has been wildly successful. And Netflix success today is largely due to the fact that the studios were willing to license all their content out to Netflix early on. But today it is changing, and to your point about cord cutting, I think there was a debate on whether it would actually happen 4 or 5 years ago. And clearly, with the declines that we've seen year over year in excess of 10%, cable TV subscribers, subscriber losses for the likes of AT&T and others, it's clearly kind of reached a tipping point. I think what people need to understand is that these trends are very long-term and durable, and it takes time to change consumer behavior, and it's very content-driven. So the fact that Netflix rose to its dominance and the pay TV bundle finally was whole, but eventually you start spending, engagement leads everything. So people start spending more time on Netflix, and then they can cut the cord. More recently, I think 2 years ago, people thought that it was just going to be Netflix, 100% Netflix. All the studios were going to license their content to that. All the media companies were going to go bankrupt. Cable was going to go away. But that's clearly not the case, at least today. What we've seen is a lot of these companies clawing back a lot of their content, putting it on their own services. The launch of HBO Max, which is the expanded HBO offering, Comcast Peacock, which is always in the news, especially as it relates to distribution with Roku, which we can touch on that maybe, because that's a little timely. But yeah, I think what we're going to is a world where that looks kind of similar to the old world of linear channels, but in over the top, where you subscribe to, Netflix, Amazon Prime, and then you also subscribe to a lot of these other services on the margin. I mean, Disney Plus was a wild success, but that means that the audience is fragmenting, right? And so I think from an investing standpoint, there's ways that you can play this theme over the next 3 to 5 years. And this is kind of what we've, put our, our flag in the ground here, where, Netflix is still the 800-pound gorilla, but we think that on the margin, they're going to lose out on their share of incremental engagement. And the future growth in OTT is really going to be driven by these new and emerging services. Now, it's not a zero-sum game here, but I do think that as you give consumers more options, that churn does increase on the margin. And so that's to the benefit of, I think, a Roku, right? Because Roku and Amazon Fire TV, these are the future over-the-top platforms. These are your future cable companies. They're the one-to-many. There's no geographical barriers. And so if I'm thinking about growth investing and secular trends over the next 3 to 5 years, I'd much rather be long Roku that benefits, in theory, from all these streaming launches, also benefits from the advertising trends, and then, on a relative basis, be short or bet against kind of the incumbent here, which is Netflix, where I think, their content costs are going to continue to rise exponentially. And then absent, this COVID bump, I think their subscriber trends are going to be very slow and continue to slow here, and the multiple compresses. So that's the landscape, and it's all content driven. The name of the game here is content. Disney was successful despite everybody thinking that they weren't going to be because of the content that they have. And it's also, from an ROI perspective, the name of the game is getting the most I possibly can for the least amount. And what we saw was, because of the brand power of Disney, that they were able to launch their direct to consumer service by leveraging their library and also only coming out with a handful of originals. And over time, all these companies are going to be investing more and more in the original content. These services get better. So I think it's a great time to be a consumer of entertainment services. That's where the value is accruing. In the media landscape and as an investor, there's a ton of landmines and value traps out there. But I think we've identified, where the opportunities are and which ones, we think that people should avoid.
All right. So you touched on that's a great overview of the landscape. You touched on a lot of companies. Let's if you don't mind, let's just go through them one by one.
Yeah.
Um, so I know last year, I'm almost certain I saw a video you were very bullish on Disney.
Yeah.
This might have been about a year ago.
Hmm.
But that was before COVID-19 hit, and
Yep.
just ground its like park revenue and like a lot of live sporting events where it has like ESPN ties, like it ground those revenue streams almost to a halt.
Yep.
So how does Disney look right now? What does its future look like?
Yeah. I mean, look, our thesis, right, when we first were bullish on Disney was that Disney Plus is going to be more successful and get more subscribers than anyone else thinks, right? And that clearly played out, and the market wasn't appreciating that. The other part too was that the legacy business had to just be status quo, right? So we needed everything like ESPN, the theatrical, to just kind of just stay constant while they built this emerging streaming service on top of it, and scale that, and then eventually be able to successfully have their foot in both boats, and then eventually take the other foot and put it in one boat, which is streaming. And so when COVID hit early on, we quickly took that idea off our list, I think in early March, because it was clear that the theme parks were going to take a hit. And this wasn't even a typical recession, right? We're talking outright closure. And so, Disney for us today, as a relative pair, I think there's better ways to allocate your capital than buying Disney, at, $130, $135 a share. So now there's two things, right? The theme parks are going to recover. Now, how long it takes for them to recover, it's probably going to take longer, because you not only have to deal with a change in consumer behavior, capacity restrictions due to COVID, but also I think we're going to see from a macro perspective a larger impact to the consumer once all the stimulus money kind of goes away. So it's really hard to see how Disney gets back to anywhere close to its kind of 2019 pre-COVID margin structure, as well as growth trajectory. So let's just put that there, right? But that's cyclical, right? And I would argue that a lot of that bad news is probably priced in earlier this year. The other issue, though, is around ESPN and the other media assets, because ESPN's the most profitable business, and that's been seeing declining margins because they've been faced with rising programming costs and declining subscribers that are tied to the bundle. Now, they're going to have a really hard time navigating that trend. They were having a hard time navigating that trend before, and there was hope with streaming. Now, with COVID, it's accelerated that trend, right? We've seen, acceleration with live sports going away. We've started to see the value proposition of the bundle come undone even further. And so now the real question is, can they monetize streaming at the same rate that they were able to do, pre-COVID, and, the way that compared to the profitability these businesses are today with these existing distribution structures. And I just don't think that's going to be possible. It was one case where we could see the business being stable, and then the rise of streaming on top of that. That's great. But today, I think it's much more challenged. Now, that could provide an opportunity. And so I think you had a really interesting tweet that we engaged on, and your question was, and I don't mean to steal your thunder.
Yeah, let's go. Let's do it.
You asked, would you be, like, if you had to invest in one company, like for the next decade, would it be Comcast or Disney or Netflix? And the thing that I struggle with Disney is that is such a huge bet on management. As an investor, you have to have so much confidence that they can basically just blow up their business model, take advantage of COVID, and take all their content as fast as they can off these existing legacy distribution models and provide enough value over to the streaming side fast enough and monetize it in an equivalent way. And it's possible, but there's a lot of rights agreements and existing contracts in place that make that very difficult to do. But it's a really great story if they can actually make it work, but it's going to be very hard. So I think you have to have a lot of confidence in Chapek and that management team. Iger is still operating in the background. I think we're going to continue to see success with The Mandalorian coming out in October, and as some of these other original content pieces get released. But at this valuation, because valuation is still important, in my opinion, I think it's a really tough bet to make, for the long term. Now, could I be wrong? 100%. But I just think I would much rather be long today, something like a Comcast that has a very profitable cable business that I think is undervalued dramatically as an investment for the next, call it 12 months, and then see how Disney progresses. They're having an investor day coming up in Q4. They'll probably raise their subscriber numbers. And that could be a positive catalyst for the stock. I think investors generally want Disney to blow up their model. They want them to come out and be like, look, our P&L's gone, to zero. We have our earnings power today is very minimal, but we at least have the cost cuts in place to generate some free cash flow. So it's not like some of these other out-of-home entertainment companies that are just basically burning cash and potentially go to zero. They have these high quality brands and assets, but they need to come up with a very aggressive plan how to position themselves. And within crisis and recession comes opportunity. And so that's going to be Chapek's legacy. He has to fundamentally transform the Disney company and put it on an accelerated timeline where they may have thought they were 5, 6 years, 7 years from now. They have to make that happen tomorrow. And I just not sure I have the confidence relative to the current price to say, let's be long Walt Disney company here. So that's kind of, what
Sure.
I think about Disney today.
I mean, they have an incredible balancing act. They must do, right. And it's like, it's just like, it'll be hard to pull off. At the same time, that intellectual property, like there's very few companies that I look at and say, well, they can't be disrupted. Like, even like some of the companies I love, whether they're tech giants or whatever, there's a path where, well, they could be disrupted. That intellectual property that Disney has those with the Marvel Cinematic Universe, the
For
Star
sure.
Wars, I mean, I have 4 children, so I'm just well aware of
Yeah.
like how sticky this content can be. My 14-year-old son, like the day the Mandalorian 2 trailer came out, or the season 2 trailer came out, which was just like this week, he, like as soon as I got home, he's like, Dad, did you see the trailer? Did you see the trailer? So I feel like there might be missteps along the way, but long term, and I'm not saying we wouldn't see better prices at some point either, but long term, I feel like because of that intellectual property, like they have time to figure it out.
Yeah, look, the assets that they have, I mean, that's one of the reasons why we were so bullish on it last year, and why we thought direct to consumer was going to be a huge success. Look, I was talking about them having 30 million subs in year 1. And speaking with very sophisticated hedge fund buy-side clients and internet investors, and they're looking at me, has anything like that ever happened in the history of the internet before? Because everyone was thinking 4 to 5 million subs. Let's look at Netflix as a proxy. But the reality is that Netflix had to build and invest and establish their brand. I've been on the record saying multiple times that Netflix is trying to do in 2 or in 5 years what the rest of the media industry has built in 100 years. And it takes a very long time to build up those types of brands, that intellectual property. And Disney has a lock on it. And so, yeah, the barriers to entry or the ability to disrupt Disney, it's Netflix is trying, right? Reed Hastings came out and said, we're just going to spend more. We're going to look, Ted Sarandos is saying we're going to explore various universes. Because they know that the way because they know that the way streaming is today, that the barriers to entry, at least from the major, tech guys and media companies, is not that high. And so therefore, the only way they can differentiate themselves is by having these big tentpole brands, which they have to build. And they have some of them, Stranger Things, Orange is the New Black, although they don't really own the rights to those. They've had Money Heist, which has been huge. And they need to continue to do that to be successful, and also generate high incremental returns on capital. And Disney has that, and that's why they were so successful. Taking a step back, though, when we're talking about this transition, it's all about monetization, right? And so we can talk about what ARPU looks like, which is average revenue per user for Disney Plus, Hulu, ESPN. But really what you have to think about is all the people that buy something from Disney, the theme parks, the home video, TVOD, streaming services, and what does ARPU and monetization look like on a corporate basis, right? And then the question is, in the future state, is Disney going to be able to monetize those users at the equivalent rate across all assets, all their properties, not just streaming? Streaming is an incredibly important part of it, but are they going to go? I'm just going to make up numbers here, right? But let's say they generate $1,000 a year per every consumer that touches Disney in 2019. Let's say that goes down to $500 this year. If they transform their business model, are they still going to be able to get back to that 1,000? And maybe they don't. Maybe they don't need to get back to that 1,000. Maybe it's 750, but it's a much higher margin business on the backside because they can strip out all these costs and use COVID as ability to transform the company and get rid of all the baggage. Again, I think that's a very interesting thought experiment, and it's possible. And your point on the brands, they're in a unique position to do that because they have the assets, they have that IP. So I wouldn't want to say I would bet against Disney, but Chapek has his work cut out for him.
They do.
Hopefully, I think they can figure it out. I'm not saying Disney goes away, but obviously not. But I think the question becomes like, what's the earnings power of this company and how much you're willing to pay for that? Because you can have the best assets, but if you've been over earning in an environment where it's been essentially inflated by the pay TV bundle for years, what does it look like on the other side? So that's a very hard question to answer for anybody, and even Disney management, I'm sure. So it's going to be interesting to see what they have to say at their investor day.
Sure. Yeah. I almost, at this point, I think we can make the whole show about Disney, but let's move on.
Sure. Let's go.
Netflix, right? So this was a pioneer in the streaming space, and longtime shareholders have certainly been richly rewarded for it. But like, as you alluded to earlier, like they kind of like got off, they launched quickly because they were able to get all this content from traditional media companies and put it on the platform. And now it's just having to pour more and more money to launch original content to gain subscribers and keep subscribers. Yep. So how is Netflix positioned for the future?
I think Netflix isn't going away. I think they run a very high risk business model, but one that's necessary in order for them to compete, keep what they have, and grow on the margin. I do think that Netflix's role in the bundle. So let me give you some stats, just top down, okay? Netflix has about 65 million subscribers in the U.S. All right, there's about 100 million or so pay TV households. So Netflix is approximately 65% penetrated in the U.S. market, right? The surveys we've run, suggest that actual SVOD penetration of all the streaming video on demand services in the U.S. is actually closer to 90%. So the streaming video on demand market for subscription and OTT services is mature. Now the question becomes, if Netflix has 65% and 65 million subscribers, right? And then you have 90 million of the total subscribers in the market. So where's the 25 million? And what we find is that as Amazon Prime Video and all these other services start to scale, you're starting to see a cohort of the market start to adopt other streaming services as their core. And that's not because, and the demographic tends to be more price sensitive, right? For Amazon Prime, it tends to be consumers that are self-described as not really content connoisseurs, right? They're not just ferociously, going after and consuming content. But that's the point. So I think the market is slowly starting to fragment, and Amazon and Apple TV and all these services are going to continue to invest, continue to grow and get more content, which provides an alternative, a substitute to Netflix to some extent. And I think that Netflix's share of engagement, share of voice, and time spent is going to diminish. And so what does that mean? That means that Netflix is hitting maturity in the US as well as in a lot of the developed markets, which are the highest ARPU countries. At the same time, competition is increasing. They're going to be losing out on the share of engagement. If Netflix wants to maintain their current share or grow their share where they're already, basically the dominant player today against all these services, they're going to have to spend much more money, increase the output, increase the quality of output in order to just keep what they have. Or they risk essentially just losing out and the market fragmenting, which I think is inevitably what's going to happen. So we already know that they have an adoption issue in terms of the number of subscribers and potential, which, by the way, I'm convinced, I know the bulls out there say that they're going to get to like 500 million subs by 2030. I just don't think I don't think that's going to happen. And they're also facing, and that's just math. That's just like looking at adoption rates in developed countries and the US. Now, there's opportunities in developing countries like India and Southeast Asia. But the problem there is that the revenue per user is coming in at a much lower price point, $2 to $4. And so you have a negative mix shift on the ARPU side. And they're also coming off of what's been a pretty good run in pricing power, where they had a big price increase last year. And I still think that there's more room to go, but the question becomes revenue maximization, right? Elasticity of demand. So can they continue to raise price while also growing subscribers? And all the pricing analysis that we've done, especially with more competition coming into place, Disney Plus launching at $6.99 a month, the whole bundle coming in, HBO Max trying to work a little bit downstream, the rise of AVOD with Comcast providing a ton of great content that's ad supported. It does, I think, limit Netflix's pricing power. And what we've seen is that $10 a month is a line in the sand, and then price sensitivity really starts to become greater once a service price is above $10. And that's where Netflix is. They're facing market saturation. I think they're coming up on the upper end of what they can actually afford to price their service without risking a bigger increase in subscriber churn. At the same time, competition is coming. People are going to subscribe to multiple services, but that means that they're also going to probably bounce around and churn more. And it's tough. I mean, especially relative to the free cash flow profile. So I think
something I've actually already done. Like, sorry to interrupt, but
no, please do. I'll just talk forever.
It's like when Disney Plus. I mean, I try to be a little frugal. I should be more frugal, but right. But as a family, like with 4 kids, when Disney Plus came out, we were like, we cut Netflix for 6 months, and we're back on Netflix now. But like we cut it for 6 months, and then in the future, we're like, well, do we want this or this? Like, I could see cutting it again for 6 months, and we've been on Netflix's platform forever. But with competition, it's like, well, it's not hard to like say, let's catch up on all our shows on Netflix. We're going to cut it for 6 months or whatever. And we'll be, so now instead of getting like 12 months from me, they're getting 6 months, let's say, or whatever.
And I think what you just described is a very underappreciated point of the churn model, because one of the points of pushback I get when I talk about churn is like, well, these users just are going to come back. And it's like, of course they're going to come back, or maybe they won't, maybe they'll turn off forever, but like odds are they're going to come back. But when you think about a subscription business and churn math, right? Churn is churn,
Right.
It's like you can subscribe on and off, 3 times throughout the year. I've done that. I've subscribed on and off because there's not something I always want to watch on Netflix, or there's another show. Like, I mean, between some of the stuff that we're watching anecdotally, just like from my household and like HBO Max and Comcast with these new services, I've canceled my Netflix subscription because why am I going to pay $12.99, $15.99 a month if I'm not going to use it? Will I come back? Sure. Or, maybe I'll just borrow someone else's password, God forbid, and just watch a show I want for a couple months. So, but it's a tough market. It's a really tough market, but Netflix is the leader. They have the best churn numbers. And so it's not that I think that it's a bad company on an absolute basis, or that they don't have a brand. I just think that on the margin, if I think about where we're going over the next 3 to 5 years, it's just things are going to be working against them more so than working for them.
Sure. So let's talk about another company now. And one of my colleagues, Austin Lieberman, is very bullish on this company, and I think you are as well, and it's Roku.
Mhm.
Many investors still think of Roku as a quote unquote device company because the devices are very popular in the streaming industry. But is that the right way to think of this company?
No, I mean, when so it's like similar to Peloton, where you have like an underappreciated business transformation, right? And sometimes those are the best longs because that's when the multiple re-rates. And when Roku went public, it was 90% hardware business making no money, right? So what do you pay for that? You pay like 2 times sales. What Roku has successfully managed to do so far is transform their business from a hardware business to a platform business. And the platform business has structurally higher operating margins, gross margins, and it's also growing much, much faster. And so the hardware business is essentially customer acquisition costs to drive growth for the platform side, which is growing like a weed. It did hit a little bit of a bump due to COVID. Um, but the future of this company 5 years from now, it's going to be a platform business, not unlike any of these other internet platforms. It's going to be advertising driven through connected TV. It's going to be the platform where you manage all your subscriptions on and rent movies. And also it's going to be a great place for brands to reach their consumers that have cut the cord, right? That unduplicated audience, I think, is going to be incredibly valuable. Because right now the big issue when we were in the beginning of this conversation, we were talking about transitions, is that yes, you have like one of the issues with pay TV and the cord cutting is advertisers are still spending $70 billion a year on TV ads, and it's getting more and more expensive to do so. And it was only until 3 years ago where you actually had a viable CTV platform for advertisers to spend on, with Hulu and Roku. And so I think we're very early days there, and there's a long runway ahead for Roku to transform its business into one of the largest connected TV platform models. Doesn't mean with that it's not without its risks and volatility, but it is one of my favorite names, growth names in my space at least. And I've done a lot of work there and have a lot of conviction in that one alongside, even though it's been a rough road. But we were long since early 2019. So, our cost basis there is pretty low.
Right, right. So like, what would you say to like the objection, or like if somebody objected, like, well, what's to stop like Samsung and LG and all the other TV makers to just kind of like make their own, I
Well,
guess
look,
for lack of a better term, app
yeah, no,
store?
well, I
Yeah.
mean, so like the bull case, and it's funny, people call like Roku the operating system for TV, and it is, at its core. It's like, very similar, this market's similar to kind of, smartphones and the App Store and Google, and how eventually it just kind of migrated around two major players when, it used to be Research in Motion with RIM, Microsoft, and et cetera. But the reality is that Roku's been competing against these large companies forever. I mean, Samsung has Tizen, which is their operating system. LG has their WebOS. What else? We've seen these other platforms just, they require a lot of, they're very high cost to build, very memory intensive platforms. I have a Samsung TV and I don't use it. So I use the TV because I think it has great hardware, but I use a Roku. I have Roku HD that I plug into. And that's just a function of the fact that my smart hub in my Roku, in my smart Samsung TV, I had to reset and lose all my passwords every 2 months. And then I was on support with Samsung. It was just a terrible experience. It was awful. And then when they would update, the hardware wasn't compliant or it wasn't good enough. And so everything would start to lag and slow down. And it was just a nightmare. And so I bought a Roku Ultra HD, and it's great. And actually, the survey work we've done suggests that about 65% of smart TV households are actually not using the operating system that came built in with the TV, like in my Samsung example, they are using a Roku. So what was like the big point of pushback? It's a platform company, so it's all about disintermediation. And I think that there's a lot of structural reasons, especially on the cost side and consumer experience, that give Roku a leg up there, especially with the contracts that they have with TCL and some of the major Chinese OEMs. There is the risk always that Google, is getting more aggressive, and so will they pay the manufacturers to get have Android installed in their TVs? And I think that's certainly a possibility, but it still doesn't come down to the end of the day where what's a better experience. And so TCL went from no market share to 35% market share of smart TVs in the US riding Roku, and they're going to do the same thing in North America, in Europe and Latin America, and we're still early on there. So, I think they're much stickier in the supply chain and embedded there than I think a lot of people give them credit for. And then Amazon, I don't think is even a credible threat, frankly, for Fire TV as an operating system, not as a stick, but as licensing out, because it's a forked version of Android and it's very expensive. And it can also be jailbroken too. And so because it can be jailbroken, the question becomes, as a media company, do you want to distribute your content on a platform where people can just jailbreak it and get your content for free and steal it? So, but that's kind of inside.
Gotcha. All right. So now, so last week or so, I tweeted out a poll, and I was wondering what your take on this would be. I said, which of these legacy media companies will provide shareholders with the greatest total returns over the next 10 years? And the choices were Discovery, which operates the Discovery Channel. I mean, I know you know this, but the Discovery Channel, the Travel Channel, the Learning Channel, a bunch of other channels like that. Fox, which still has a lot of regional Fox Sports networks, and Fox News, obviously, the New York Times, and Viacom CBS.
Oh, boy.
How would you answer that question?
Well, so first of all, for those who are listening, I have not seen that poll, so there's no bias here. So I'm just going to tell you exactly what I would think in order. And it is hard. So my go-to, when I think about legacy media, I tend to think that broadcast has a leg up still relative to traditional cable. So with that being said, we immediately take Fox, and Viacom and kind of put it to the top of the list. Then the second question becomes, what are their digital assets and what do their content assets look like? And so Viacom has Pluto TV, which is growing like a weed. They also have Paramount and the studio business and CBS. Now there are issues around sports rights and what that's going to impact for margins look like for Viacom. And then, Fox has Tubi, which they purchased. They actually were an investor in Roku, sold that earlier this year to buy Tubi. So, and what was the duration? 3 to 5 years?
10 years.
10 years?
Yeah. Well, whatever. Just take 5 years. 5 years.
Yeah.
Is fine.
No, I mean, I don't know. We're all dead.
I mean, we're all just playing. Yeah. I mean, whatever.
That's a famous quote there. I would probably say
in 10 years, I'll have you back to have you answer for this.
Yeah. No, for sure. Hopefully we're all on a beach somewhere by then.
Right.
I would probably say, Viacom. I would say Viacom.
That won the poll. It won the poll.
Okay,
whatever
good.
That's worth.
Yeah, I would say Viacom, Fox, and then Discovery.
Okay.
So I mean, Discovery has great assets. They do, but I just don't know if they have the distribution in place, and I don't know if they can make that switch to OTT.
I'm not familiar with any of these names, but whenever I do a poll, like after the results are in, like I'll just like go through real quickly, like a thread where like I just look at Y charts for them on different metrics. Mm-hmm. And after I was done with that, Discovery now
super cheap
looked the most interesting, right? Its margins were decent and its valuation is super cheap.
Yeah, you got like John Malone in there too, which is helpful. And it's very cheap on a free cash flow basis, but there is debt. I mean, the issue, and we saw this with we were short AMC Networks, which was like basically just The Walking Dead. And then we were also short Viacom CBS all last year. We shorted that thing all the way to like $12. So it worked. And then earlier this year, it's just like, it's not going to work. It's not worth it anymore. Same thing with AMCX. But the issue is just around cheap gets cheaper. And so the question with Discovery is you have to ask yourself as an investor, it looks cheap, but like, are they going to be able to, is free cash flow today going to be greater or smaller 3 years from now, 5 years from now, 10 years from now? And I think, you could probably make a strong argument that their free cash flow is declining, and that, what is the value of Discovery as a standalone company, or does it just get super cheap and does it get snatched up by a larger network or somebody that could take that content and monetize it better? But Viacom CBS has had a nice run, and it's still relatively attractive. But there's challenges in legacy media, right?
Oh yeah, for sure,
Many, so it's hard. You got a lot of landmines you have to dodge.
Are there any other surprise winners or surprise losers that you see in this overall landscape that we haven't touched on?
Surprise winners or surprise losers? No, I mean, I think we kind of hit on it. Nothing that's like, nothing that's like super gems that are like undiscovered. Right. I think that the themes are fairly straightforward. And that, I think that if anything, probably people are just still too optimistic on Netflix, which I think is going to, probably show up in this quarter's results and, the next kind of 6 to 9 months. Roku, I still think, despite it being almost a 20 billion EV now, is still, a lot of people don't understand that company, which is great, because I think that means that, the more debates I have about it being a hardware business makes me more bullish, because that means that people just fundamentally just don't understand this business. And so that there's actually a larger investor base out there for them to come to realize that this is a great growth story and start to invest. So that's also where the opportunity is. So, I do think, Roku would be my horse to ride 100%, going forward. And then AVOD generally, I think there's a lot of skepticism around like Tubi and, which Fox bought, like I said before, and like Pluto TV, because investors are largely like, who wants ads? Who needs ads? And it's like, there's a large portion of the population that will take ads for a subsidized price. And there's a market for it. So I think those assets are underappreciated, and we could see an interesting scenario where for Fox and Viacom, which is why I kind of picked those two, where it's possible that those businesses that are growing very fast eventually become more than 50% of the business, and therefore the consolidated growth rate inflects, and then we're kind of off to the races.
Sure. All right. One last question. Last night, I think it was last night, you tweeted something, you retweeted something. It was about the TikTok IPO, and you quote tweeted it and said, yes. So are you a buyer of the TikTok IPO?
Look, I've looked at the numbers, like what TikTok has been able to do from a virality standpoint and monetization standpoint. It's just been remarkable. It puts everyone to shame except for Facebook, because they're kind of on a similar path. And it also makes you wonder what Twitter did wrong when it came to their purchase of Vine. Why that didn't, it's bad timing, right? But, I don't know. Everything has a price, and I think it's an interesting platform. And there's the engagement metrics, like I said, on the data side from the app download stuff, and time spent is just exploding. So I think I am definitely bullish on TikTok from everything that I've seen and know now. The question just always becomes, like, if they file in the US and we get an S1 and we go through our process and tear it down and do all of our channel checks and figure out what it's worth, if TikTok US comes public and, it's, it goes public at like 100, maybe prices at 50, 60 billion and trades open at like 120, 130 billion or 150 billion. I mean, we saw what happened with the Snowflake IPO. So, then it's like, well, okay, it's probably a short,
sure.
There's nothing left. But I do think that the growth is undeniable. You can't ignore it. It's top of mind for a lot of advertisers, and the engagement is fairly astounding, especially relative to Snap. So, I've actually been thinking that maybe if that goes public, it's potentially it's more negative for like a Snapchat on the margin, right? From just an investor source of capital. But when I said yes, I mean, I'm just, it's being me being a little bit selfish here, right? Because
sure.
Analyst, as like a public equity analyst, like that covers this space, I would love to be able to cover TikTok, and have more market cap and interesting company, rather than if it gets like carved up between US and ex-US and gets owned by Microsoft or Walmart or Oracle. Like, that's not fun. That's kind of sad. It's kind of boring. So let's get this thing public. Let's break it open. Let's keep it a global company. Kevin Mayer, man, that guy who's, he's the former direct-to-consumer head at Disney, and he launched their whole, Disney Plus, and everyone thought he was going to be the new CEO, which ended up not being the case. But he went over to TikTok earlier this year to lead the global company, and and because of the policy and political dynamics that unfolded, he then resigned. But man, would that be just bittersweet if turns out that they actually go public as a separate company in the U.S. and he could have been the CEO. To
it seems like he's the real loser in all of this.
It's
because
I don't know.
He went there, and then like all this stuff happened, and he left, and now.
Like, I think we've all kind of, as investors, gotten too caught up in the short term and trading, right? And so there's that concept of getting whipsawed as a trader, where you may be right in the long term, but then you just execute terribly, and so you buy at the wrong time, you sell at the wrong time. I just kind of think about it like that,
right.
Where he's just potentially, he played himself, that he's just got himself whipsawed, maybe making decisions in haste, his ego getting the best of him. I don't know. I'm just speculating.
Right. Sure. Yep.
It's not like I have him on my cell phone.
Right,
but
right.
just reading the tea leaves, it's just one of those situations where it's tough. But it's going to be interesting to see how it plays out. I'd love to see a TikTok IPO. It'd be a lot of fun.
For sure, for sure. Well, let's wrap up our conversation there. Andrew, where can people find you if they're interested in following you?
Yeah, thanks. So we're all over Twitter, everyone at Hedgeye, but you can find me on Twitter at hedgeye.com. You could also find us at hedgeye.com. We have a large institutional business, but we're starting to get more so into the middle market space for professional investors by launching some new products. So you'll see more from us on that. I'm launching Communications Pro, which is going to be a lot of what we do on the institutional side, but breaking that open to more investors in a very hyper-focused, very deep format. So it's going to be a lot of good data, all focused on the internet media telecom space. So I look forward to that happening in Q4. And I think if you guys subscribe and want to get feedback, love to hear it.
That's great. Andrew Freedman, ladies and gentlemen, thank you so much for coming on today and discussing investing with us. Again, I'm Matthew Cochran, lead advisor with 7 Investing, and we're here to empower you to invest in your future. Have a great day, everyone.